Today is our 10th office hour. So we've had 9 sessions before now. And today we're going to focus on cash flow statements. So we're going to see how you can extract the cash flow statement from the income statement and the balance sheet. And because that's the only thing we are focusing on today, I'm going to use an approach that will make it really, really easy. So if you've been someone who has always have issues with cash flow statement before now, you should no longer have any issue with cash flow statement going on. So I have here, let me just pull up the template we're going to use, demonstration. Okay, so I'm going to use this, which I've built from scratch already, and the file, the section of it that we want to do today is the cash flow. So again, just to let you have a quick understanding of the entire financial statement. So every company will always have financial statements that reflects the income statement, that reflects the balance sheet, and that reflects the cash flow. Okay, so what we want to do is a case of you are the one preparing the account statement, right? You are the one preparing the financial statement. You already have the income statement, so we already have the income statement. You already have the balance sheet, so say we already have the balance sheet, right? How do you create out from it the cash flow statement? So how do we create out the cash flow? I am going to wipe off what I have on my screen, and version, and I'll wipe this one off without damaging the original version. So I'm going to wipe off everything on the screen. Okay, so when it comes to cash flow statement, right, there are 3 segments of the cash flow. There is the cash flow from cash flow operation. There's also the cash flow from investing, cash flow from financing. So I'm going to just quickly pull up my drawer. So the cash flow statement has 3 segments. The cash flow from operations, which reflects the money that we made from the business operations. So your profit, if you are very fortunate that your company runs in such a way that your customers pay you, they don't owe you, you sell off your entire inventory, you don't have any payables, you'll find out that your cash flow from operations will be very close to your profits, because that means everything, expense and all that you've settled or cash settled. So what you will have left will be your profit, right? So that would be like the cash your business generated. But in real business, in real life, things are never always cash based. So you have sometimes that some people have bought your product and they're still owing you money. Sometimes you'll find out that your inventory is still not yet fully sold out at the end of the year. So when we adjust for all of those things, we'll get a cash flow that has come out from our operations. Then there's the cash flow from investing. So cash flow from investing shows your capital expenditure, and if you if you divested any aspect of your business or sold off any fixed assets, it's going to be captured in investing. So one quick way for us, if you are building this, is to think long term. Anything that goes into long term, that goes into maybe long-term assets, long-term liability, know that they will be captured in the investing. Whereas everything that is short-term on your balance sheet side are captured in the cash flow from operations. Okay? So that's one of the very straightforward way to get the computations right. Once you have that in mind, it's very easy to know what to move to what. Then cash flow from financing. So did we raise new money? Did we also take on new loan? So you find out that anything that relates to loan, that relates to equity, that those ones are captured in cash flow from finance. So let's start with the cash flow from operations. I'm going to zoom my screen and then so that you will be able to see clearly what I'm typing. So normally you have to bring in your net profit. We call this the indirect approach, but so far it's becoming the global approach. One interview I had to do for a US firm to join as a consulting, well, like a on-demand consultant kind of, right? And when they were going to interview me, there were like 4 stages, and it got to a part where it was going to be a practical, like a project, and I was going to solve it right there during the Zoom session. It was cash flow statement they told me to create out of balance sheet and income statement. So it's a fairly common thing. So anytime you are told to create cash flow from balance sheet and income statement, you will have to use this indirect approach where you start with the net profit, then you want to adjust for non-cash transactions. You all know that depreciation and amortization is a non-cash line. It's something that you do because of the regulations around how you arrange your income statement, but it doesn't necessarily impact cash, right? So we take that out. Similarly, I'm going to take out finance income. Maybe we should go at this one. If I bring in my income, net income, so the net income the company has made. So ordinarily, if the company is a very simple one where everything is cash based, you could even find out that this would be exactly the cash that will be in the account. That will be the cash generated that year, right? But unfortunately, like I mentioned, or should I say fortunately, things are never that straightforward, right? So let's see how we're going to be adjusting it. So I'm going to go here, by the way, so that it's easy for you to follow the lines. I will turn the grid lines on, and so that way it's easy to know where we are. I'm going to go here and say this is equal to, so let me increase the zoom. I'm going to say this is equal to from the income statement, the net profit starting from the first year. Okay, all right. So I bring that in here, and then I drag it into the future years. Okay. Then, like I mentioned, we need to adjust for non-cash items. So things that do not impact cash, but that we have taken out in our income statement. Number one is this one. D&A is something we have to take out. Or should I say we have to add back because we've taken, so I need to add back D&A because it's a non-cash line. And then finance income and finance cost, these two we will, because they are related to debt, it's a lot more natural to have them in the cash flow from financing. So because finance income is added to our profit, right, I'm going to minus, and finance cost deduct from our profit, I'm going to add it back. So with that now, I will be done with the adjustments on the income statement. So let's go and do exactly what I have said. Yeah, going to minus the finance, and I'm going to add finance, and like we already did the other time, we go and pick the D&A. So I go pick the D&A from the income statement, because it comes there in minus, right? So I will want it to show as a positive sign since I'm planning to add them back. If you notice, it's showing here, the pattern here is expenses are showing as negative, but we plan to add it back. So what I have to do is ensure that I make it pop up as positive. So which means that after I do equal to, I want to take out the negative sign, make it show as a positive. So that way I can just add it directly like that back into my profit. Okay, so I do this. Then we go to the finance income. So for the finance income, I plan to remove it. So let's go and pick it in our income statement. And then I'm in finance income. And finance income, well, because this company does not have finance income, you will not see that it's normally positive already. So in real life, you want to minus it, which means that when you do equal to, we want it to come in a negative sign, okay, so that that way I can just by adding it up with the other values, it will deduct from my profit. So I drag that into the future. By the way, if you have any question, let me just set it so that I can see any questions easily. Using two screens so I can be able to monitor questions people ask. Just put this one in, I'll make it see. Session farm. So if you have any question, you can always ask. You can even interrupt me. It's going to be the class is meant to be a very relaxed one, no big rules. All right, so I'm going to add back the finance cost. So equal to income statement, right? And then the finance cost. If you notice here, the finance costs are coming as negative already. So I have to, fix that sign part of it. So which means when I come in here, I add back I put a negative to knock off the negative. So that way it will be added back to my profit. Okay. All right. So these are the adjustments that we make from the income statement. So all these ones, right, that I've done relates to the income statement. Okay, now, as regards the cash flow from operations, imagine that a company has closed down. A company has closed down. So this company, let's say ABC Limited, ABC Limited, has closed down since end of last year. But you know what? They have stuffs in inventory. If they have, say, 100 million naira worth of products in inventory, if they sell this thing at the end of year 2020, even though they have ceased operations since year 2019, the money that comes from it is going to come to cash flow from operations. So you need to factor in changes in working capital, inventory. If they had debtors that hold them, let's say they had in their receivables 50 million naira, even though they have ceased working, technically they've closed down operations, right? If those debtors pay them, that money, that cash that comes in is going to reflect in cash flow from operations. Similarly to if they have people they owe money, payables, right? So the moment that they make those payments, it's going to also deduct from this money that has come in. So it's not just what you make as regards your revenue and expenses that just flow into the cash flow from operations. Well, as regards what is captured in income statement anyway, there are some aspects of your balance sheet also too that will impact your cash flow from operations. So let's now go and capture those ones. Okay, so I'm going to, like I've mentioned, things change in inventory. So working capital changes, that's what they are called. change in inventory is going to reflect in our cash flow from operations. Change in receivables, change in any other current assets. So maybe prepayments, things that you've already come under your current asset but are not inventory and receivables. Okay, so changes in them reflect here. Likewise, on the liability side, change in payables, change in maybe other accruals or any other liabilities you have anyway. So change in other current liabilities. Okay. So let's talk about what kind of change in inventory will become, or what way you will capture change in inventory. So I'm going to drag this away so that it's no longer occupying, since we are okay with the explanation. In fact, maybe I should just delete it since I've already explained that, and if you missed that explanation, you might need to watch the video. So let's talk about inventory. Let's talk about how inventory impacts our cash flow. So imagine what I said. Company ABC, right? In year 2019, in year 2020. Now, this company has ceased operation from 2019 end, which means in 2020, they did not manufacture any new products. They did not they've closed down operations, right? So we want to see what impact inventory will have. So imagine that at the end of year 2019, they had inventory worth of 100 million. Now, because they've closed shop and they disposed of the inventory, which means at the end of year 2020, the inventory is now 0 million. And that money that they make from disposing of that inventory is going to go into cash. So if you look at the cash accounts, it will go up by that 100 million naira. So if you want to do mathematics that will give us this particular outcome, it will be last year inventory minus this year inventory. And from there, you will see that this will be 100 minus 0, and that's how you would have eventually come up to that cash flow going up by 100 million naira. So just remember that inventory, receivable, similarly to for receivable, if we had people owing us 50 million naira at the end of last year and they all paid up this year, that 50 million naira they paid is going to reflect in our cash flow as going up by 50 million. And again, if you look at it, it's last year minus this year. So whenever it's an asset side, so just remember, if it is assets, change in working capital is last year minus this year. That's how you're going to get the direction it will have on your cash. And if it's a liability, so let's see how a liability works. If I owe my suppliers, so payables, if I owe my suppliers 20 million naira at the end of last year, since I've closed shop and I'm fulfilling all obligations and receiving money from those owing me, if at the end of 2020 I've paid those suppliers that I owe, I will have to take from our cash account to make that payment, right? So you find out that when payables or liabilities go down, the cash goes down. Similarly to if they go up, if it is that at the end of last year I did not owe anybody, and then at the end of this year I'm owing people, that money that I'm supposed to pay them is still in my bank account. So you can easily just say for liabilities is always this year minus last year. If you did not borrow money last year and then this year you borrowed money, that money that you borrowed is going to reflect in your cash account. That's what happens when you borrow money. they transfer it into your cash account anyway. So you find out that it's this year minus last year for anything on the liability side. Now that that is clear, we are going to effect the formula in our model right now. So I'm going to just have to knock off all of these things. Let me delete all these that I've written so that the screen will be clear. Draw. Okay. Delete. 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 Okay, so now we are going to effect all what I've written. Like I've mentioned, inventory. So everything that is on the asset side is going to be last year. So it's going to be equal to last year. Go to the balance sheet. I'm going to pick it's equal to last year inventory. So last year inventory minus this year's inventory. Okay, so if you look at it, last year is F, this year is G, so F minus G. Okay, so that is that, and I drag it all the way to the right. Now we go to the receivable. Receivable is similar to, I'm going to say equal to last year. Last year receivable. Last year receivable minus this year. And if you look at it again, F is last year, this year is G, right? So last year minus this year, okay? Maybe I should just do them and drag all at once. So let's do for other current assets. It's going to be similar pattern. So I go here, other current assets, again, last year minus this year. So if you look at the formula again, F, which is last year, minus G, which is this year. Right. So all of the asset side of the working capital, let's drag. Right. So that is done. Then we do for the liability side. And as I have told us, for liability side is this year minus last year. So it's equal to this year. So if I go into the balance sheet and I go to the liability side and we start with the payables, this year minus last year. So if you look at the formula, it is now G, which is this year, minus F, which is last year. Okay, and then other current liabilities. So if I go there, you'll find out that again we are doing this year minus last year. All right, and with that we are done with the assets, the liability side of it all. Okay, so and which other things do we have to fix in our model? Let me just on Zoom so you can see what we have done. We have captured now the portion that is coming from the balance sheet, the working capital side. I'm going to open for you a live financial statement of a company on the stock exchange. I'm just going to pick any company, and then you will notice that there's still one more aspect that is being reflected that we now have to reflect in our house. So I'm going to just let's see, let's pick a manufacturing company. Let's even pick for like 2019. Okay, so maybe we use corn oil, right? So if I open corn oil's annual statement, okay, so let me on Zoom. It's coming up. Okay, so I am going to scroll and scroll to, okay, I'm going to zoom again. So we are on the cash flow statement, right? All right. So if you look at what you're seeing here, this is very similar to what we did in we brought in the profits, and then we took out depreciation and amortization. That's all of this, right? Then we take out interest related, like interest expense, interest income. So anyway, we adjust for the things on the income statement, which is what we've done here. We adjusted for the things on the income statement. Then the next portion is the balance sheet, which is just what we have done now. We adjust for change in inventory, change in trade, in receivables, change in payables, change in other, like in this case, this is change in other current liabilities. When customers have paid you and they've paid you for something you've not done, that is sometimes we call it deferred revenue. So that one shows up in your liabilities because it's money that you've gotten that if that sale doesn't go, you would have to give it back. It's not, you can't recognize it as money that is yours yet. So now this is, are you noticing there's something else? Tax paid. This is not letting it come out the way I want because they started from profit before tax. If they are started from profit after tax like us, you will see two things here rather than just paid version. You will see the tax expense, not just tax paid. So let me just open another company, one that most likely will have followed the pattern we are using, so that you'll be able to compare apple for apple. I'm going to, I think Nestle follows, most companies follow this pattern we are using. So anyone I open, there's a good chance that what we have done is what they have done. MTN Nigeria. Let's open MTN Nigeria and see. So I'm going to quickly scroll to the section where the income statement is. All right, so let's see. They are using the direct method, so not good. I'm going to have to, they are following their South Africa pattern. The group company too does direct method, so I guess maybe that's why. I'm going to pick out Seplat. Okay, so I think we are getting there now. Consolidated. All right, changing cash flow. This is also direct. Why is all the companies we are picking using direct? Let's try Nestle. Nestle. Okay, PZ. There's also PZ here. Let's try PZ. PZ. Okay. Sorry about that. It's a very unusual coincidence. If I open like 20 companies, not less than 15 of them will be the indirect method we are using. So that's the most transparent method. Okay, so this is a very wonderful one. They are also using the direct method. They just put the cash flow directly. They no breakdown. Theirs is even worse. I'm going to just try one more company. Where's the Nestle I was trying to open before now? Or let's try Nigerian Breweries. Anyway, the thing I want to show you is there's something called tax paid and tax expense. But I want you to see it in a live company report, so that way when I'm explaining it, you will not have any qualms about the explanation. Okay. Okay, I think this awesome. So they have it that way here. Cash flow. Are you noticing exactly what we did? We started with the profit for the year, which is net profit. Then you adjust for non-cash items. So we took out depreciation and amortization. Are you seeing that this is almost matching line for line what we did in ours, right? Okay, this is the very transparent version of it. Companies who do this, they are being very, very transparent with the breakdown. And then we took out the finance income and the interest expense. You see, income, finance expense. Okay, then any other non-cash stuff that was captured in the income statement. Now see, income tax expense, income tax paid. Those are the two things that we don't yet have in our own, right? That's the things that is missing out. We've done the changes in working capital. We've done the adjustment for the income statement. We need to also capture for differential between the tax that is captured on the book and tax that you pay. So tax. The truth is that in the income statement, whatever you put here as tax, computed as tax, is your accounting tax. Is following the accounting rule. It's not always going to be the tax that you end up paying. In fact, it's the audited account you're going to use to go and process with the tax official the tax that you're going to pay. So like for us now, we have to do this audited account. Our accountant has to do it, and then we will now take that to FIRS to start processing the tax we will eventually pay. So there's always the difference between what you have in your income statement as the tax that you pay or that you are supposed to pay and what you actually pay. And as you know, it is what you actually pay that impacts your cash flow, right? So that's why you will have to, add back that tax in your income statement. It's usually called tax expense. The tax that you expensed out of your income statement, because that one, nobody paid it. It's just something that was used in creating the financial statement. Then you now subtract the actual tax paid. Okay, so this is now what you will use to get your cash flow. The only thing is just that usually there's a difference of a year between what you paid this year for what you owed last year. So you need to have a line in your book. So typically you have like a tax schedule that will help you capture that difference. Okay, so in our own situation, it's very straightforward for us because we have already done this tax schedule to show what we eventually pay versus or what we capture in our book versus what we pay. Okay, so I'm going to just pick it directly from there. Sorry, I need to unzoom. All right. So zooming it back so you can see as I'm typing in what we captured in our income statement. What we captured in our income statement as the tax that we paid is, where is it? This one. But because we are adding it back, right? So we are adding it back, I have to take out the negative sign. So I have to go back here and make sure that it comes back as a plus. and I drag it that way, it will come back as a plus. Okay, and then what we actually paid. So that one, if you have done a tax schedule, it will be easy to go and capture from there, you know, what is the tax that you eventually paid. So it's the current income tax. You know, it's the one that captures the differential in timing. Okay, and I drag that down. So because this company is starting afresh, so everything is on a projection basis. Nothing has yet been audited and paid up. So that's why there's actually no difference. They are kind of matching. So the other thing is, because we are taking this out, we need this to show as a negative, so that when we add up everything, you will have the things in their correct cash direction sign. Okay. It's like I didn't drag this to the end. Okay. So that's it for the cash from operations. Remember, you start with your profits, you adjust for non-cash items in your balance sheet, in your profit. So you adjust for all the things that did not impact cash in your income statement. Then you go to the working capitals. So the working capital are things related to your current assets, to your current liabilities. So change in inventory, change in receivables, change in other current assets, change in payables. If you look at the one I opened, this PDF file I opened of the Nigerian Breweries, you will see the pattern is similar. Profit for the year, adjust for depreciation and amortization, adjust for the things that are supposed to go and feature in the cash flow from financing. So finance income, finance cost, finance income, finance cost. And then you'll be like, oh, what about all these other things? So they captured some things that are like gains and loss. So, you know, gains on sale of plant property and equipment, you know, things related to employee benefit, revaluation of gratuity employee benefit and share-based payment charges. So things that they had to capture but did not affect cash. So if you look into the finance statement, if you look at the income statement, you will find out that those things that are taken out are things they added there just for disclosure purposes, right? They did not impact cash. Yeah, okay, so we are there. I think you will have to read into the notes to see some of them. Where is the one from loss? If you read into the note, this other income, a lot of times we'll have captured some of those things. So our own business does not have that. So that's why we are not adjusting for stuffs like that. And then after that is done, you will notice that as we said, inventory, trade receivable, you know, everything that is related to the current asset and current liability. Inventory is current assets. Trade receivable is current asset. Prepayment is current assets, which in our own will have fallen under other current assets, right? Payable is current liability. Provisions, current liability. Deposit for import is current liability. Customer has paid you, and these imports here are is on their own side. They are the ones who got the money, so it's not the other side. That's why. Yes. So it will have come under other current liabilities for us anyway. So, and then the one I just explained to us, the tax expense and the tax paid. And these ones again are things related to what they did. So other long-term employee benefits paid, share-based payment, VAT paid. So they decided to separate VAT from some companies will only capture revenue net of VAT. They, in their own case, they captured revenue inclusive of VAT. So that's why they had to remove the VAT part. And then also when you lay off staff and you have to pay their benefits, so that part is also captured in here. Normally it will have reduced your provisions for staff going, current provisions. So this is just for disclosure, like making it very, very transparent that they are writing it separately out from the provisions because it has been affected. So provisions will have gone down and it has been affected as similarly to for this. So I'm just trying to explain that everything here is just because Nigerian Brew is a big company, so that's why you'll find out that some of these lines have been exploded. Other current asset was exploded into all those lines that you are seeing there. So we move now to the cash flow from financing and from investing. So cash flow from investing, so let's do that right now. Cash flow from investing. And like I told us, cash flow from investing relates to whatever happens to your long-term side of your balance sheet, apart from financing, equity and debt. Every other thing that is long-term in your balance sheet side is captured here. So what are the kind of long-term stuff? Capital expenditure, asset disposal, also actually, though right now the IFRS rules is not very strict about where your finance income shows. So even finance income and finance costs, but based on the logic of it, finance costs, because it's the debt you pay to, is the money you pay to, is the cost of servicing your debt. So it makes a lot of sense to make it show in financing activity. Whereas finance income is earned on your investments. So when you have money in say treasury bills, in government bonds, in investing in stock market, in putting your money in some interest-bearing long-term investment account, you find out that that money, that finance income, is best reflected in this cash flow from investing. Okay, so similarly to if you have done any financial investment, is captured in here, and generally anyway, change in other fixed assets. So any other thing in our fixed asset side is captured here. Change in other non-current liabilities. So the fixed side, the long-term side of our liabilities too. So all of that we capture here to show the cash flow from investing activities. Okay, so I'm going to start doing the formula part of it anyway. So let me on Zoom. Let's check if there's any question. Okay, so it seems no questions right now. So I'm going to start the formula side. Let's start with the capital expenditure. Okay, so let me illustrate how you will capture the capital expenditure. If you look at your balance sheet, so if we look at the balance sheet, anything that you spend on Kpx is going to reflect here in the fixed asset side. So all Kpx, which are like capital expenditure, they impact your fixed asset side. So let us think about how in real life on paper, how this impact is captured. So imagine that you have again ABC Limited. So ABC Limited. Now let's talk about year 2019, year 2020, and the fixed assets. So think about it. If the company has plant, property, and equipment worth 200 million naira at the end of year 2019. Now, the thing is that because of depreciation, even if the company does not buy any new assets, if there was a depreciation of 20 million naira, the book value will be 180 million naira. Right? So now, what if the company bought new assets? So if the company bought new assets, so if there was a Kpx, of say 40 million naira this year, you will find out that this Kpx of 40 million naira will flow into here, and what you will have will be that the net book value. Let me just erase what I have here. The net book value will no longer be 180 but 220. So the net book value will be like 180 plus 40. So 180 million plus the 40 million Kpx, right? So what formula could have gotten this for us? Which means that this will be reflecting 220 million, right? The formula that will have gotten for us if you did not have this Kpx, if you don't have this Kpx line, which we don't have in our balance sheet, what we have from our income statement and balance sheet is just the PP&E and the D&A. So what formula would have gotten for us that Kpx calculation? So the Kpx formula is this, which is what we want to get out. It's going to be equal to PP&E this year plus D&A this year. So you add back the D&A this year. Then all of that you will minus from the PP&E last year. So if you follow this approach, you will be having 220 million this year plus 20 million minus 200 million. And if you do that, you find out that's equal to 40 million. And that correctly captures that we spend a Kpx of 40 million naira. So you can see how this formula extracts from us that Kpx that we all know was a 40 million naira spent. So I'm going to have to type this formula in my Kpx calculation. So I'm going to go back to the cash flow. Let us zoom, and exactly as I've written the formula, equal to PP&E this year. So PP&E this year. In fact, if you are not trying to break down all of these things, you can just do it on the entire summation of the fixed assets. But since we have broken it down in our statement cash flow, let's just follow the breakdown. And so I'm going to say PP&E and fixed and intangibles, because also intangibles relates to the things we do the D&A on top of. So I'm going to say, okay, is the summation of this plus this for this year. Okay, so this is now these two. No, let me rewrite that. Summation of the intangible and this. So you can see here 9 and 10. That is this year's value plus D&A this year. So those are the things that are depreciated. So I go to D&A this year, D&A this year. Because my D&A is already in minus, I have to take out that minus. So minus make it turns back to plus. Then all of that now will be minus the D&A for last year. I mean the PP&E for last year. So minus all of our fixed asset last year, which is like the year before. So the year before. Right. That's how I have captured this formula I've written here. PP&E this year plus D&A minus PP&E, right? Okay, so I do enter, and I hope we are following. I know it's this can never substitute for having to be doing it yourself, but the key thing is just for those of us who you've always been having issues with cash flow, this will help you to overcome those issues. Now, the other part of it is that in the direction of cash, expenditure is negative. So if we want that captured in the direction of cash, I have to like put all of this in a big minus so that it comes in the direction of the cash. Expenditure is always used spending. That's why it's called expenditure. So this way we are able to now capture what we spend on Kpx. Then disposal. Actually, the company didn't dispose of anything. So that's why here we can write it. But in real life, whenever they dispose of, what will have happened that this would not have been a minus, this would be like a plus. And then whenever this is a plus, we know that's a disposal. And whenever it's a minus, it's an acquisition, Kpx expense. So we are going to move to the next one, finance income. I don't have to even sweat. I can simply just bring in the finance income from here. But since we have minus it here, I need to bring it back as positive. So I bring back the finance income, and then that one also I drag all the way to the right. And then we go to the financial investment. Let me show you again Nigerian Breweries account. Some companies they have investment accounts, right? Meaning, let's see, okay, Nigerian Breweries does not have. The other ones I open, let's check if any one of them has. But at least you can see the finance income I mentioned now. You can see the disposal, acquisition, and we have added our PP&E and intangible assets, so that makes our life a lot easier. Let me check for another company and see a company that has invested. Why is PZ statement like this? This is okay. Investing. Let's see from see investments. So Seplat made an investment in a JV. Can you see that it's captured in the cash flow from investing, right? Similarly to if you didn't even invest in a joint venture, if you just invest in stock market or in a particular fixed income stuff, you will also capture it in the cash flow from investing. Well, for the company we are doing for, this is more of a startup. So right now they don't have any financial investment. So we don't have it. And then we go to the other fixed assets. So other fixed assets, remember what I said about asset. Direction of cash on cash is always last year minus this year. So I can go back to our balance sheet and say, other fixed assets, and I do last year minus this year. And with that, I drag all the way to the right, and I'm done with that. The company does not have, it's a startup, so its structure is a bit straightforward, no other fixed assets. And then other current liability, because that's the liability, non-current anyway, non-current. So that's the liability side. Is always this year minus last year. If you remember when we were doing this, liabilities, the change on direction of cash is this year minus last year. So other non-current liabilities, go to this year minus last year. Okay, so let me just verify. Yeah, G minus F, and I drag that all the way to the right, and that gets for me. And that brings us to the end of the cash flow from investing, right? So everything for cash flow from investing comes from the, well, everything except the finance income comes from the balance sheet. Just the finance income comes from the income statement. Okay, so now we go to the last section of it, cash flow from financing. This one is very straightforward because you are capturing things that revolve around debts and equity. Did you raise new debt? Did you raise new equity? Did you pay off some debt? Did you buy back equity? So let's enter the line items, finance costs, any bank overdraft that was drawn, or sometimes you can call this short-term debt, short-term loan. And then any senior debt, any regular long-term debt. So debt, let's call it long-term debt that was raised, long-term debt issued, long-term debt repaid, then dividends that you pay because you pay dividend out of the equity guy's money. So it's something that impacts equity. Then did you raise equity? And did you buy back equity? So in the direction of cash, this one is always like a minus, right? So this one comes in form of a minus. If you want to remember, sometimes you can do it this way. This one comes as a plus, repayment is a minus, dividend is a minus because you are taking it from cash and you are giving to your investors or your shareholders. Buyback also too will be minus. You don't have to, I'm just doing this so that you can see the direction on cash, but it's not like you must always write it like this in your statement. So I already have the finance cost somewhere here. I can go and pick it. The only thing is because here it's coming as a plus, I need to make it be in minus so that it will come in the correct cash direction as it should be. Then bank overdrafts or short-term loan. So do we have any short-term loan? Let's go to the balance sheet and check if there are any short-term loan under the current liabilities. At this point, I need to even delete this. Let me delete them now so that it does not disrupt the flow. So, all right, good. I'm going to remake that formula. Let me also delete this. Delete this. So I go and recreate the formula equal to, for short-term loan, go to the balance sheet and we pick the short-term loan. So that one is straightforward, we are picking. Similarly for long-term debt issued, I go to the balance sheet and then I pick long-term, where is the long-term debt. Because in the balance sheet we didn't separate them out as there's nothing separating out issued / paid. So sometimes if you want it to be very obvious, you can just say slash repaid here. Sorry, there's something I've been doing wrong so far. For the loans, you need to take the differentials anyway. So it's because the same is a liability. When it goes up is more to you. So it's the differential I should have taken. Just remember that now. Sorry about that. So for the short-term loan, it is this year minus last year. So did you take new loan? Did you repay the existing one? In fact, if I know that I don't have, I'm picking it from the balance sheet, I can just even instantly put it here, repaid, in brackets, so that I don't have to break it out into two lines. So I can be able to delete this line and also this one. Okay. Similarly, I do for the long-term debt issued or repaid. So go here, long-term debt. This year minus last year. Then dividend. Well, we have an equity schedule, but if you don't have equity schedule, you will have to minus it out from changes in retained earning, because you pay dividend out of retained earning. So changes in retained earning, we get to dividend. Okay, so for us, I'm going to just come here and pick it directly from here. This plus this from my equity schedule, what I paid out. You can see it's always coming out of retained earning anyway. But assuming you don't have retained earning, I mean you don't have this debit equity schedule, how would you have gotten it? It will just be retained earning this year minus retained earning last year, then plus profit this year. Let me write that down. Time is okay. I will be quick with you writing it out so that if that's the situation you have in yours, imagine that again ABC Limited. We want to talk about dividend 2019, 2020. If you made a profit of 100 million naira in 2019, you know all these profits we normally go and you put them on your retained earning. So let's say by the time you had it, your retained earning goes up to 900 million naira. Then if you want to pay dividend comes out of the retained earning, right? So now let's talk about, let's say you did not pay any dividend that year. Then again next year you make 100 million naira. Now this 100 million naira we had to last year's retained earning. So now you should be having 1 billion naira in your retained earning. But if you decide to pay a dividend of 100 million naira, then it will have to come out from your retained earning, such that your retained earning will now become 900 million. So if we don't have this line, what formula can we do to get out this, that we actually pay dividend of 100 million naira? That formula is what I've just said. Retained earning this year, now minus retained earning last year. Then because the profit for this year is added into the retained earning this year, so we need to take it out so that we'll be able to effectively know what was paid as dividend. Okay, so if you now say minus profits this year, and if we do it, you will see that it will get us that will pay the dividend of 100 million naira. Let's do it together. 900 million minus last year 900, then minus this year's profit 100. This will cancel themselves out. The answer is minus 100. And because dividend is a cash outflow, that's why it's coming as a minus. So that's the formula if you do not have an equity schedule that you can go and directly pick the dividend schedule from. So I'm going to delete this, and then we will wrap it up. So wrapping it up means I do equity raised. Equity raised is again going to be changes in equity, in share capital, kind of. So changes in the share capital line. Let's see. So changes in share capital and other equity items. So I'm going to just pick that line. This year minus last year, last year. So if you look at it, share capital this year minus share capital last year, then other equity items too. So anyway, once I do that, I will get what the equity we raised is, or buyback we made, and then that's all what we drag into the future. Okay, and with this now we can compute our net cash flow. In fact, we can compute the total for all of those different breakdowns. So for this, I drag it all the way to the right. For this equal to sum of all of these, and I drag all the way to the right also too. Okay, and lastly for this equal to sum of all of these, and then I drag all the way to the right. Then the net cash flow is going to be equal to the summation of all of those three. It's going to be equal to this plus this plus this, and we drag all the way to the right. Okay, and then you can do your check if what you've done is correct or wrong. So to do the check is, what is the opening cash flow from the balance sheet and closing cash flow again from the balance sheet, and then what's the change? Is that change the same as our own? So you can do a check. Is the change the same as ours? All right, so normally you will have completed this one, because the cash flow balances needs to be used to balance the balance sheet anyway. So let's see, we have done this one correctly. Okay, and did I choose the right line? So opening cash flow, let's start with the closing cash flow. Closing cash flow will come from the balance sheet. So closing cash flow from the balance sheet, you take it, you drag it all the way to the right, and then opening is equal to last year's closing. Okay, so what you close with last year is what you open with this year. I drag that. Okay, and then the check that we are talking about is equal to closing minus opening, and that will give us the check, change in cash flow, and so this change in cash flow is this one minus this. Is it coming to 0? Okay, so there's a problem. Ours is not balancing. So we need to troubleshoot and figure out where is something wrong. So I work backwards. Okay, so I don't know where the something wrong is, but we can always troubleshoot it. So this one looks correct. Then I go into each formula one after the other and check if I've summed the things correctly. So this looks correct. In fact, let's go to ones that have figures. So this looks correct. And then profits. So what I do is I put this on the side. I do side by side. I go to view menu. I go to new window. So I'm showing you how I typically troubleshoot. So I put this one on one side. I put this one on the other side. I need to put this on the other side. Okay, let me just put it here. And then we can quickly be able to, oh boy, it's already 12 minutes past the hour. All right, I just hope it's not a big problem that is causing it, something we can fix on this same session. So I am going to start checking them one after the other to see where things have gone wrong. So I look at this one. Let me just reduce. For now, let me hide this so that I can be able to show them on the same screen. What have I done? Hide is what I want to do. Hide that one. Okay, great. So let's see. Profit is the profit matching with the profit we have in our statement. Okay, so this is wrong. Where did I see this one that I picked now? All right, so I think this formula that I picked here, for some weird reason, I've picked the wrong thing. 279 J39. Oh, it's correct. Huh? What I have is circular referencing. So calculate. Let's see. End cash flow. Okay. Right. Is anything still looking off? I think my Excel is working on a manual calculation instead of auto calculation. But anyway, let's quickly finish it. So this one is matching. DNA is, let's check it out. DNA is matching. Finance costs, finance income is not matching. Finance cost is matching. Finance income is not matching. Okay, I think I've picked the wrong thing in that one. Let's check. J33 2019 should be we'll come back to that one. And change in inventory. So it's my cash sweep that is giving me wahala. All I have to just do is very simple, straightforward thing. I'm going to just remove the formula underneath the cash sweep, paste it as value, so that those things, they just knock themselves out of the loop. Okay, so let's see if things are okay. All right, so the figures are matching now here. This, let's see trading receivable. Let's go to the balance sheet to go check out the balance sheet items. So for inventory, minus, okay, I think I've done something wrong in inventory one. Picking J13, instead of J14. So this is inventory. Inventory is on line 14, not line 13. So I just need to fix that in the formula. Line 14 is inventory. and I drag that to make sure every other person is complete. Let's see if that fixes it. So that was the cause of the problem. All right, so thank you for staying this long. And as you can see, I came across a problem and I was able to fix it. It's just the logic. Once your logic is correct, every other thing will work correctly. Let me undo the thing I did. And we have to close the session here. Inventory. Any questions before I stop the recording? Thank you for staying this to the end. And any questions? As usual, the recording will be put in our community link. So make sure you are part of the community. Let me just grab the community link for us. And the recording, I know I still owe us last week's recording. Recording will be posted. In fact, let me even get to the eventual Google, YouTube channel. So we have a YouTube channel where all the recordings are even directly posted. Let me grab for you that YouTube channel link, so you can even go and watch the ones you've missed, the previous sessions. So, any questions? In the absence of any question, once I paste this link, I'm going to have to end this webinar. This meeting, because we have Excel in about 40 minutes. So YouTube page of the recordings.